Well, macro headwinds no doubt taking a toll on corporate results, as we've been talking about, and underwhelming numbers for big tech pointing out some glaring weaknesses in the global economy. Major data points held above water for some time, but is the slowdown we've been fearing so long finally here? We've got Ines Ferré and Julie Hyman. Julie making an appearance on the 11 a.m. show. Let's start with the earnings, because we just went through the big tech ones there, but there's another one that I know, Inez, you've been watching, and that's Texas Instruments.
Yeah, that's right. And Texas Instruments is important because their chips go into everything from home appliances to missiles. So the scope of where their chips go is very significant here. And Texas Instruments basically saying that they are seeing softness, especially also going into the industrial segment. So that industrial segment that seemed to be immune to sort of a softness inside in the chip space, a slowdown in the chip space, that is notable. Now, analysts had been talking about that we would see a slowdown in the chip space, especially in the second half of the year. But again, that scope, you also have, of course, the Biden administration restrictions when it comes to chips and China that's also weighing on here. But the bottom line, from what I can glean from this, is that basically this slowdown that we're seeing, it's not going to be a quick turnaround. Julie, your thoughts on that?
Well, it's interesting what's going on with Texas Instruments. It seems like everything slowed except autos is what analysts were pointing out. That was actually a bright spot because that's a spot where the automakers are sort of in an arms race where that is concerned. So for me, the takeaway is that this is very lumpy. And this is something we were talking about in the last hour, not just within chips, but within everything, right? Because if you look at results from something like Visa, which was out with its numbers as well, from there, the indications seem to be that consumer spending is still relatively strong on things like perhaps travel, right? So it's not that businesses and consumers are not spending. It's the spending is on different things. They're spending perhaps less, maybe overall. Certainly companies seem to be, judging by the results from Microsoft, for example. But it's not sort of an across the board things falling off a cliff. It's sort of lumpy slowdown.
But doesn't that go back to sort of like how do we look at what the macro picture looks like, right? I mean, we've been talking so much about how there's this divergence between where consumer sentiment is versus where consumers are actually spending, and that yes, there are concerns about higher prices, and yet when you look at sort of the broader labor market, things are still pretty tight. And this sort of seems to add to that idea of it being a little noisy and not being able to have a very clear picture on where things are headed.
Yeah, definitely.
And if you also look at the home data, for example, I've been also watching that because as housing goes, so does the economy. This is another area where we are seeing September new home sales were down in September. And you saw also in September the mortgage rates, those climbed up to by 100 basis points. That's a huge amount in 1 month. So now it's just sitting just around 7%. You are going to see a slowdown in this, in the housing market. We are already seeing it. And keep in mind, the housing is a lagging indicator. So when we're talking about these different areas of the consumer, how the consumer feels, where it's spending its money, housing is a huge component of the economy. It encompasses so many jobs, from construction to mortgage lending, and then it also encompasses the durable goods. So dishwashers, everything that has to do with building a home and what you put inside the home. I think that there's different areas, as you mentioned, of the economy. It is a little bit lumpy, and it's just which areas do you want to focus on and which are lagging and which are the ones that indicate.
Well, in going back to what we've been learning from earnings, I mean, Chipotle is kind of an interesting story. You know, they raise prices, a lot of companies have, to offset the cost.
Yes.
They did beat expectations, and yet it does seem to suggest that there are trade-offs that are happening among consumers.
Well, and they talked about that the lower income consumers are not coming in as often. Transactions actually fell at Chipotle by 1%. They're going to fall by a higher percentage in the current quarter, according to the CFO, Jack Hartung, who we spoke with earlier today. And so not only are you getting lumpiness among what consumers are spending on, there's a lot of differentiation amongst consumers. So whereas a higher end consumer might still go out and spend a house, even though buy a house, maybe they're spending less on that house. Likewise, you're going to have a big differentiation between higher and lower end consumers and what they're buying, where they're traveling, et cetera.
Well, I mean, even that, even if, you know, so lower income customers aren't coming through the door as much, higher income maybe spending more, but even for higher income, that is a trade down, right?
Yes. Yeah, it could be, definitely, if they're buying Chipotle and not Capital Grill. I don't know. We're like,
I don't know where they lunch. I'm not
right. Exactly. But yes, there could be some decisions being made there.
And we know that inflation impacts the lower income consumer as well. So that is expected. These are, I mean, we've seen it with even the dollar stores in the previous earnings, where they show where consumers are spending, and they're maybe not spending on the T-shirts. They're now spending on food, on the consumable products.
Yeah, something we've heard from other retailers too. Groceries over other purchases. Good to have both of you on.
Thanks.
Ines Ferré and Julie Hyman.